1, go.
Hi folks, and welcome to yet another edition of Who Moved the Market. It's Friday, we have our Friday smiles on, but maybe not so much for the bulls. Well, I'm Surabhi Upadhyay, you know me, I'm usually here every day around 2 o'clock. Joining me on the show today is Latha Venkatesh, because if you put up the question, who moved the market, it has only one answer, and that, Latha, is central banks. So much action, my God, 4 banks hiking rates in 24 hours. What's happening?
That came as a bit of a shock. If you remember the day before our monetary policy, June 8th, on June 7th you had Canada and Australia hike rates.
Yes.
So these do tend to come in bunches.
Only 6 central banks, suddenly going up and hiking rates.
And so now you had the BOE, and what was important is the Bank of England, the pound is still an important global currency, as is the Swiss franc. So when they move, it's important. The pound moved, the BOE moved by 50 basis, which is quite strong, and now it becomes as high as it was in 2008 global financial crisis, before all the cuts began. So that's something you should take note of, 15-year high, and likewise for the Norges Bank, another 50 basis, again a 15-year high.
Wow.
The Swiss National Bank actually is better placed because inflation is the lowest in Switzerland among the EU countries.
Okay.
But even they had to increase by 25 basis.
They had to do.
So that kind of puts everyone in notice. The ECB has raised, but it is more like a deposit rate. It's not.
That's not a rate hike. Direct rate
it's
hike.
not like the normal, the one that's linked to the lending rate. But still, the direction is very clear. It's upward.
Okay.
So all that is because it's by the major currencies. It's put everyone on notice.
Absolutely, and these are big Western central banks, so you can't ignore all of this. We'll come to the market impact in just a bit, but I want your thoughts on 2 more central banks. One is Jerome Powell. Let's actually talk about the Fed, and I'll come to Turkey. That's the really interesting one that I'm sure a lot of you want to also know about. But the week actually started with the Fed chair speaking at different events in the US, right? What's the read through there? It's clear that the Fed also will hike. This has just been a pause.
Yes, the dot plot made it very clear already in 3rd of June that they are going to increase interest rates not once. Everyone was prepared for, or many were prepared for a July hike. But the dot plot saying 2 hikes was a complete shocker. We were not very sure what Jerome Powell would do because in the press conference, he was not as hawkish as 2 hikes. He did say there would be hikes, but didn't quite subscribe to 2 because when people were asking him about skip and pause, many people are now not calling it a pause. It's just skipped one and continuing with the rate hike. So he said no, I would not like the word skip. So there was a bit of an ambivalence, but his testimony to Congress clearly indicates he is still in favor of hikes. His question being that if you are guessing that we are going ahead in terms of hikes, that is a very good guess. Provided economic conditions are what they are, but he does say that he will carefully space them out. Right. So it doesn't look like it will be July and September. It may be maybe July and November, or space it out is what he says.
Okay, now for those of you who might be wondering what we're talking about, what is this dot plot? It's this basic chart. Latha will be best placed to explain, but basically all the voting members put out their projections of where they see the hikes coming.
That's the correct way to describe the dot plot. We were trying to push it on RBI and the governor once answered saying, don't we have enough speculation without a dot plot? But basically 18 members of the Fed plot where they see the repo rate, their repo rate at various points in time. So many of them saw it at, now it is between 5 and 5/4, so 5.1 say. They see it at 5.4 and then at 5.6. So now the median has moved to 5.6 and 9 out of the 18 members expected. So now it's no longer laughable, it's a majority.
Oh, absolutely. So there you have it. This is a chart which basically tells you where the US Fed is moving, and that chart says we're getting 2 more rate hikes, at least 50 basis points more. Which now brings me to Turkey. Okay, Turkey from a market perspective is probably not that important. It's a bit of an outlier market, it's an emerging market. But just the headline was staggering yesterday, Latha. 6.5%. Who hikes rates in one day by 6.5%?
Well, perhaps this is how dictatorships work. I wouldn't know. But Erdogan, for the longest time, in spite of double-digit inflation, kept cutting rates. And I'm saying Erdogan, I'm not saying Turkish Central Bank, because it was directly under his charge that he ordered the central bank, or ensured the central bank would cut rates. But now he has come back with a majority. So probably the sense now is that, and it was a bit of a narrow, election. So probably now he's interested in setting the house in order. It's a 40% inflation almost, or in that ballpark. What we hear from foreign press reports is that businessmen were expecting him to take it to 20%. He has stopped it at 15. But nevertheless, those are extreme circumstances, and I guess this had to happen someday.
So there you go. I mean, so we've discussed Bank of England, we've discussed the Norwegian Central Bank, the Swiss National Bank, the Fed sounding hawkish, ECB sounding hawkish, and of course there's Turkey on the sidelines as well, which now brings me to our country, the Reserve Bank of India. I remember that in the policy, commentators were describing it as a hawkish pause, right? And now you have other central banks anyway sounding even more hawkish. So does it mean that the RBI could start to, maybe get a little aggressive as well?
Well, there is only one of the 6 members who are actually talking about a hike, and that is Michael Patra, the RBI MPC member, the deputy governor, who says that you should not assume that a pause in this policy is not another hike. He's the only one almost clearly saying that. Of course, a pause doesn't mean the next step is a cut. But his statement is so clear that he's saying it can even be a hike, so to speak. In as many words. The governor also calls it in this tightening cycle, it is difficult. So he's still calling it a tightening cycle. I think the Reserve Bank was aware that Canada and Central Bank after pausing, Canada and Australia after pausing had to hike. So they mentioned that as well in the minutes, that other central bankers have found after an assessment of the pause that they have not gone far enough. And therefore, that is one point. One of the members saying that even a hike is not ruled out. And plus other members like even Shashanka Bhide and Dr. Verma, all of them agreeing that this is the right time to pursue the 4% inflation. That is the set target. So we have to go there. With all of them speaking in near unison, I would say that this counts as a little more hawkish than expected. The minutes in particular. The only member who didn't sound as hawkish or definitely sounded dovish was Ashima Goyal, who worried that we should not raise the real rates. And the real rate is whatever is the interest rate, the nominal rate, minus inflation. And as she says, we have to look at forward. 1 year forward inflation and 1 year forward, say the 1 year T-bill. Now, if 1 year forward you're looking at, say, a 4.5% inflation, and today the repo rate is at 6.5%, so the T-bill will be, 1 year T-bill will be, 6.6 or thereabouts, then you have a 210 basis point difference. That, she says, is wide. A real rate of 100 to 150 is fine. Beyond that, it can actually hurt growth. So she seems to be hinting that RBI should concentrate on the real rate. And actually Verma, who spoke to us on television afterwards, agreed that we shouldn't allow real rates to rise much. So to that extent, you can say there were 2 dovish voices.
It's a slightly divided house with some doves as well.
Seriously, divided house. Yes. In fact, one of them, Verma, did not even vote for the stance. He voted against it, didn't agree to it. So there has been division in the house. All I can say is that overall, the minutes sounded a dash more hawkish than what the press conference had already prepared us.
And then, of course, there's the governor himself. On the day of the policy, he said that, this plus minus 2% being in the zone is not good enough. The target is 4% inflation, so we need to come down to 4%.
Our job on inflation is unfinished. He said it on June 8th. He has said it in the minutes.
Okay, so there you go. Which now brings me to the market interpretation, Latha. I think till just about a month back, most notes you would open and most market men you'd speak to, their favorite phrase was long pause. Central banks have reached this and now we're in for a long pause. Some were even arguing for rate cuts this calendar year by the time the year draws out. So is it safe to say that those expectations need to be toned down now?
They have already been toned down by the June 8th press conference.
Even around the world. Even if you talk about market men and market commentary around global markets.
Absolutely. The CME Fed Watch tool is telling you that they are beginning to pencil in rate hikes and the cuts are far into mid next year. The Indian swap market normally tells you what you are expecting by way of hikes, and the swaps before the June 8th policy were penciling in For a brief period in October itself, a cut, and then it got pushed to December, and then February on the eve of the monetary policy. But after the policy came, it went to April. Lately, it has gone behind even further. April, very few chances. The swap market is penciling in a cut in June and October.
June and October. We're talking well over a year from now. So, okay, now to the bigger sort of macro interpretation or like the market interpretation of this. We've been through phases where markets love rate hikes, contrary to, popular wisdom, just because it's taken as a sign of great economic strength, underlying economic strength. So markets go up, rates go up. But the reaction now has been very different, at least in the last, 48 hours or so. Markets have been at elevated levels, a lot of markets have run up, but we're seeing this uncertainty, we're seeing red in equities, in crude. Crude sold off 5%. So how should we, piece it together?
Okay, well, just one more word on the MPC. The Indian markets didn't move much to the MPC. They look at it as all talk. And almost all dealers said the reaction is more to global rate hikes, and we will wait for Indian data and action and not. But to come to the relation, very interesting relation between interest rate hiking cycles and stock market behavior. Well, you are as senior in the stock market. You remember the 2004 to 2008 period.
Absolutely.
13 consecutive rate hikes by Alan Greenspan, and the stock markets went from strength to strength.
Absolutely.
You could say that of the last 12 months, 15 months from March of 22, the Fed started hiking, and the Reserve Bank as well. You've actually seen the markets do very well. Of course, till last October it went very high, and then there has been a correction. But overall, the markets are higher from when the rate hike started to now. Whether it is the US or whether it's Nasdaq or DJI or Sensex and Nifty. That's because with each passing time, the market convinces itself, or the most conservative authority in any economy, the central bank, is saying that I'm hiking rates because growth is very strong. Growth is too strong. And that's why you're hiking to slow the pace. So the rate hikes are taken positively. But if you remember, after 2007, bear stearns happened. And after that, the rate hike saw the markets fall off like a cliff. So there is always that fear that when you are at the end of a rate hiking cycle, now who is to say whether the Fed will stop at 5/4, 5/2 or 5.75? We do not know. And therefore, there is always a volatile reaction towards the end of the cycle that the accumulated 500 basis will suddenly result in growth falling off a cliff. So that is the fear that is now dogging the markets at this point in time. It may well overcome it.
Absolutely, and I think markets also got a gentle reminder of how all rate hike sprees are not perhaps that easily digested because of these mid-sized US banks. We had a few of them blowing up to just about 2 to 3 months back. So there are casualties, and there is a sort of a cost involved when interest rates perhaps go up so dramatically.
I have a feeling now the expectation or the fear that the regional banks can capitulate the entire financial system has receded. People are hardly even talking about it. At the moment, the fear is more about whether you realize that you have hiked too much only after growth falls off down suddenly. At the moment, that fear is receded actually, because look at the non-farm payroll numbers. For 14 consecutive months, they have been higher than market estimates. In India, the Q4 GDP, Jan, Feb, March GDP came in a full 100 basis points higher than what the market estimates were. So growth winds are very strong at this point in time. So the expectation is that even the cumulative effect of 500 basis points of hikes in the US and 250 in us will only lead to a mild slowdown. In the US, maybe a mild recession, and for us, a mild slowing. That's the confidence, and that's why you're seeing probably market not falling much.
Well, if the idea is to target inflation, maybe it's already working. Look at the way crude has been selling off. So we need to
certainly see working in India.
Yeah, absolutely. All right, Latha, thank you very much for explaining all of this to us. It just reminds us that at the end of the day, when you're coming to markets, big boss are central banks. They really have the levers when it comes to it. Thank you for joining in. It's been a pleasure speaking to you and listening to you, of course. All right, folks, with that, we're out of time on this edition of the show. Thank you for watching. Keep sending us your feedback, your comments and queries. Have a fabulous weekend, and we are going to see you once again on Monday.